Following a bruising past year for investors, markets opened 2023 in much better spirits. Most major asset classes enjoyed strong returns, with global equities up over 7% in dollar terms in January. Global bonds up by close to 3%, with corporate and emerging market bonds outperforming that, and gold up almost 6%. This represents a continuation of the recovery we've been seeing in markets over the past 3 months or so. Since the lows in mid-October, the MSCI World Index of Developed Market Equities is up nearly 20%. Emerging markets are up by slightly more, while government bonds have also gained over 7%. There have been 4 primary factors supporting this rally. Firstly, growing confidence that inflation in the US and Europe has peaked, supported by various data releases showing slowing headline and core inflation. Focusing on the all-important US market, the Fed's closely watched PCE measure of inflation fell to 3.9% annualized in the fourth quarter, still above the target of 2%, but at the lowest level since early 2021. Secondly, a key driver of declining inflation has been the fall in energy prices, particularly natural gas in Europe, which fell 20% last month and is 80% down from the peak last summer. This reflects a relatively mild winter and successful restocking of storage tanks, which materially reduces risks of a previously feared shortage in Europe next winter. Oil has also been falling, down over 10% since a year ago. With this, investors have become increasingly confident that the peak in the monetary tightening cycle is close. There's only 1 or 2 further hikes expected in the US, and several other central banks are also expected to slow the pace of rate hikes. This is a key contributor to the relative easing in financial conditions in recent months. And the fourth factor has been China, following the sudden lifting of COVID-related restrictions late last year. All of a sudden, the world's second largest economy goes from being a drag on global growth to providing a significant tailwind, as huge pent-up demand, particularly for services and international travel, will be unleashed. Various support measures for the ailing property sector have also been well received, which altogether has propelled China's stock market to a 50% gain from the October lows. With all this, the mood in markets has gone from being incredibly bearish a few months ago to cautiously optimistic now. However, there is a risk that markets are getting ahead of themselves in the shorter term, with potentially overly optimistic expectations for a soft landing in the economy and an early end to the monetary tightening cycle. We do retain our generally constructive view for markets this year, with peak inflation behind us and the peak in the tightening cycle close. But there are downside risks, especially given the extent to which monetary tightening, as we saw last year, works with lags, and the slowdown ahead could be more damaging to corporate profits than is currently priced in. Valuations in some markets, notably parts of the credit sector of bond markets, have become less attractive as yields and spreads against government bonds have fallen in recent weeks. And with cash offering the highest yields since the global financial crisis, some pause and consolidation in these markets is likely.
The Harmony multi-asset portfolios all enjoyed a strong start to 2023, with returns ranging from 2.9% in the cautious income strategy to 6.4% in Asia growth in January. The Momentum Global Equity and Sustainable Equity funds returned 6.8% and 6.5% respectively. Pleasingly, this goes some way to reversing the tough conditions and returns of 2022. By and large, most of the Harmony portfolios have retraced about half of their 2022 drawdowns, which bottomed out in October last year. With rates carving out a more dovish path in January, we saw widespread gains across the portfolio holdings, from our bonds and bond funds through to growth equities, whose valuations benefit from lower rates. Our exposure to SANS Global Growth Equities pushed out a 13% return in January, but that was knocked out of the park by another global manager, Contrarius, who notched up a whopping 20% return over the month. Contrarius are a deep value manager, while SANS is very much growth oriented. Their return profiles differed through 2022 as the rates reset punished growth stocks. But January's performance shows that both extremes of investment styles can perform when conditions align, with both managers outperforming the global equity benchmark return of 7% in January. Gold also closed out a very strong month, adding around 5.5% in dollar terms, taking gains from early October to just shy of 20%, although they have fallen back at the start of February. Again, the yellow metal, which pays no income, is a beneficiary of lower yields as the opportunity cost of holding it falls. Gold producers, who are in effect a leverage play on the gold price, posted gains almost double that in size. We own both in the Harmony funds, probably 2 to 3% in gold ETF and 1 to 2% to gold producers, again through an ETF. Another area of strong performance was in a couple of the UK-focused property investment trusts. Eddystone Property, which focuses heavily on retail parks in England and Wales, gained almost 10% in January, with the Schroders Real Estate Investment Trust slightly outperforming that one. At one point, Schroders was up 18% during the month before falling back later in the month. These are trusts whose prices got knocked back a lot in the summer last year, and we're now seeing a strong recovery in pricing. Certainly, the standout performer in the debt space was the Ashmore Asian High Yield Fund. It powered ahead some 20% through January as the dropping of COVID restrictions in China, coupled with Chinese governmental policy measures aimed at freeing up the frozen Chinese property sector, helped propel the beaten up Chinese property bonds higher. We placed our first trades into the fund just before Christmas and added to these in the first few days of January. So we captured the bulk of the month's gains. It is a volatile fund though, so sized accordingly, anywhere from 75 basis points to 2% in the Asia Growth Fund. In spite of the sector's huge rally off the October lows, we believe there is still plenty of upside on the table for 2023.